The strength of the US economy has led the Fed to pause its rate cuts, which began in September 2024. After a 100 basis points cut, the Fed is now monitoring the progress on inflation. The core PCE was 2.8% in December 2024, close to the 2% target, but the last 80 basis points of improvement has been challenging. The strong labour market suggests current rates are less restrictive than a year ago. The pause gives the Fed time to evaluate the impact of President Trump's policies on immigration, taxes, tariffs, and deregulation. Before the election, bond markets were already concerned about Trump's potential victory. The US 10-year yield started rising in September 2024 as his chances of winning increased, with Singapore interest rates following suit on a smaller magnitude. Since assuming office, Trump has acted on his election promises, threatening tariffs on Mexico, Canada, and China, along with reciprocal tariffs on US trading partners. These actions have introduced volatility in the bond market, causing short end of the yield curve to rise due to inflationary concerns, while the long end of the yield curve to drop due to growth fears. The bond market has reacted to both the Fed's pause and Trump's policies, with the Fed Fund futures pricing just one cut for 2025 and another for 2026. This is a sharp reduction from September 2024, when the market had expected 6 cuts for both 2025 and 2026. Reflecting this, the 5-year US Treasury rate has risen 90 basis points from 3.4% in September 2024 to 4.3% in February 2025. In January this year, the MAS eased monetary policy by slightly reducing the slope of the senior policy band. The combination of moderating inflation and slower growth momentum enabled the central bank to pursue such a policy. The MAS is also monitoring the impact of Trump's policies on Singapore's economy. This easing of monetary policy has led to a narrowing of interest rate differential between the US dollar and the Singapore dollar, reducing the cost of hedging US dollar assets to Singapore dollar. As seen in this chart, the cost of hedging decreased from around 1.8% to as low as 1.4% in January 2025, potentially making US dollar assets hedged to Singapore dollar looking more attractive. The potential repercussions from tariff-related trade issues could cause headwinds for the Singapore economy. This could lead MAS to ease again, which could further reduce the cost of hedging US dollar to Singapore dollar. The Fed's wait-and-see approach on rate cuts, combined with market concerns over Trump's inflationary policies, has led interest rates to rise from about 6 months ago. We believe the shorter end of the yield curve looks attractive. While the market is concerned about the inflationary impact of Trump's policy, it's important to note that Trump is aware of the negative impact of inflation on the ordinary Americans. Trump's use of tariffs may be less aggressive than feared, as it could be a negotiation tactic with trade partners. US dollar bonds hedged to Singapore dollar now looks less expensive from 6 months ago due to higher US rates and cheaper hedging costs. Therefore, we believe a portfolio of Singapore dollar and US dollar investment grade equivalent rated bonds in the 3 to 5 year range could potentially offer a yield of 3.7%, making it an appealing investment for the Singapore-based investor.